Let's get straight to the action, though. Hightower Chief Investment Strategist Stephanie Link and Jefferies Chief Market Strategist David Zervos. Both Stephanie and David are CNBC contributors, and it's great to have you both here to kick off this hour. David, I'm going to start with you. You're on set with me. Obviously, the big news of the day is the Fed cutting by 25 basis points. But after a year, several years where it's really been the Fed has been the biggest mover of the markets, not the case. We are still talking about animal spirits with the 49th record close for the S&P since the start of the year.
Absolutely. I think it definitely goes down as one of the most boring Fed meetings we've had in a long time, which can be good news for the markets, and the markets did take it that way. There were some nuances. I think in the Q&A, there was a lot of confidence about inflation. Jay just felt very confident that it was housing services that was keeping it a little elevated in core and that was coming down. He talked about it rolling off.
Do you think that was warranted, or do you think that was also just steering clear of policy and politics?
No, I think it's warranted. He's always careful to say, Morgan, I don't want to declare victory too early. That's a big thing for him. But, in his analysis, it's just you detected the confidence was probably never stronger, and just reiterating how they're in a good place. I also felt like on the employment side, he said we really don't want to move any further up in the employment rate. We feel like we're at the right place. We don't want to give up any more ground to weakness. So I think at the margin, the bond market interpreted that a little bit dovishly. We saw bond yields come down a little bit. And frankly, I think the most amazing thing over the last 2 or 3 days, to take the election and the Fed together, the 10-year note really hasn't moved, maybe 4 basis points, 5 basis points. If you would have asked the compendium of investors that I speak to on a regular basis, what they would have thought on a Trump win for bond yields, I think most of them were at least at 20 basis points higher for 10 years, and some maybe even higher than that. So the bond market has really held in much better. And I think that's helping equities. I think equities are seeing that and going, aha, we don't have to worry about the bonds dragging us down with too much of a higher yield.
It's such a key point. Steph, I want to get your thoughts on the cut we did get from the Fed and the commentary from Powell, because yes, it was a boring press conference for the Fed chair, but that was despite the fact that journalists were lobbing election and fiscal policy question bombs at him, and he was ducking and diving and intercepting them left and right. Case in point, take a listen.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
This is a key point, right? Because despite all the attempted, jawboning or politicization that's out there, the rhetoric that's out there around what Fed policy and monetary policy is going to look like under a Trump administration, and whether the president-elect is going to have a hand in determining any of that, we talk about something like trade or tariffs, and a lot of the power around that actually sits with the president and the executive branch. But when you're talking about monetary policy, a lot of the power sits with Congress, which was a key part of the messaging from Chair Powell as he was getting these questions today. So how does that set us up looking to monetary policy to 2025?
I mean, I think that was the most entertaining part of the press conference when he said no really sharply, right? So, look, I think he's just trying to concentrate on what he can control. And in terms of the job and should he step down if the president asks, if it's legally he can stay on, he's going to stay on and he's going to finish the job. And quite frankly, he's done a great job in terms of getting us to this, whatever we're calling it, soft landing or just a nice economy growing at 2.5%, 3% with lower inflation. Sure, it's not where they want it to be, but it's certainly making progress. I thought his commentary about looking at the 3-month, the 6-month, and the 12-month numbers in terms of PCE, the 3-month is almost close to 2. So that's what he's looking at versus the 12-month annualized, which was at, in terms of core, which was at about 2.7. So, and he's just focusing on the fundamentals. And we're going to continue to be data dependent, unfortunately. And you get 2 inflation reports, 1 job report between now and the next meeting. So we'll have more of an idea. I think you're at something like 65% chance that they are going to cut in December, but we'll have to wait and see. I think he sounds very measured. And again, like kind of right down the middle, kind of boring, but that's okay. I think the markets like boring. And oh, by the way, I would say one last thing. we have like 2 out of the 3 main events this week we've gotten through. We've gotten through the election, check. We've gotten through the Fed meeting, check. Now we got to get through China tomorrow in terms of do they announce more stimulus. But it's been a heck of a week, and the market's hanging in there in a big way.